the most. Once again, good day to you. In the wake of the COVID-19 pandemic and aggravated geopolitical tensions, the global economy has entered a period of persistently high inflation and weaker economic growth. Many developing economies are yet to fully recover from the pandemic. Global economic conditions remain fragile. Russia's war in Ukraine will continue to impair production and trade of a wide range of energy, food and other commodities. The supply of energy to the euro area is limited as winter approaches and is likely to reduce growth this year and next. With rapid inflation and withdrawal of policy stimulus, the United States will also experience slower economic growth. China's recovery from the COVID-19 outbreak and resultant lockdowns remains uncertain. The much-needed resumption of international travel and tourism will take time to generate large benefits. Taking these and other factors into account, the SARB's forecast for global growth in 2022 is revised down from 3.5% in the May meeting to 3.3% and is lowered to 2.5% for 2023 and 2024. The International Monetary Fund has also signaled a lower global growth forecast for 2022 and 2023 in its upcoming World Economic Outlook update. Although policy settings in the advanced economies remain broadly accommodative, policy normalization by major central banks has accelerated and higher yields are tightening global financial conditions. Investor appetite for riskier assets is weaker and asset values in major markets have declined sharply. Last year saw the South African economy expand by 4.9%. This year, the economy is expected to grow by 2%, revised up from 1.7%. Growth in output in the first quarter of this year surprised to the upside at 1.9%. Stronger than the 0.9% expected at the time of the May meeting. Despite this outcome, flooding in KwaZulu-Natal and more extensive load shedding are expected to result in a contraction of 1.1% in the second quarter. Growth in the third and fourth quarters is forecast to be 0.7% and 0.4% respectively. The economy is forecast to expand by 1.3% in 2023 and by 1.5% in 2024, which is below the previous projection of 1.9% for both years at the time of the last meeting. Despite these downward revisions, economic growth remains above a low rate of potential. Private investment has strengthened on the back of the recovery, but public sector investment remains weak. Household spending remains supportive of growth, but is likely to soften next year due to higher inflation, lower asset prices, and rising interest rates. Tourism, hospitality, and construction should see stronger recoveries as the year progresses. With potential growth revised somewhat lower for this year and expected GDP growth higher, the output gap narrows slightly faster over the forecast period. The output gap is expected to turn positive in the second quarter of 2023. Overall, and after revisions, the risks to the medium-term domestic growth outlook are assessed to the downside. Commodity price movements in recent months have been mixed. The export price of coal has increased alongside oil, while prices for metals have declined. Oil prices spiked to around $130 per barrel in the early days of the conflict in Ukraine. While oil prices currently sit at around $106 per barrel, we expect them to stay higher than we did in May and to average $108 per barrel for 2022, $92 per barrel in 2023, and $85 per barrel in 2024. 2024. South Africa's export commodity price basket has come down from earlier peaks and is now forecast to rise by 3.2% for the year as a whole, before falling in 2023 by about 19% and by a further 8% in 2024. As a result of these export and import price and volume developments, the current account balance is expected to register a surplus of 2% of GDP this year, falling to 0.4% in 2023 and to reach a deficit of 0.4% in 2024. Although fiscal risk has eased on the back of better tax revenue and reduced borrowing needs, financing conditions remain tight and the yield curve for rand-denominated bonds is steep. 10-year bond yields increased to about 11.4% in recent months. Policy normalization in major economies and the slowdown in China have contributed to rand depreciation in recent months. The implied starting point for the rand forecast is 16 rands 10 cents to the US dollar compared with 15 rands 88 cents at the time of the previous meeting. While economic growth is slowing globally, inflation continues to surprise to the upside. Sustained policy accommodation, supply shortages, and other restrictions have sharply increased the prices of many goods, services, and commodities. Producer price increases continue to pass through to wages and consumer prices globally. Our estimate for inflation in the G3 is revised higher to 6.9% in 2022 and up to 3% in 2023 and stays unchanged at 2% in 2024. A higher global oil price and rand weakness contribute to higher expected fuel price inflation for this year at 38.9% and to 4.5% in 2023. Local electricity price inflation is unchanged at 11% in 2022, 9.2% in 2023, and 10% in 2024. As a result of higher global food prices, local food price inflation is also revised up and is now expected to be 7.4% in 2022 and 6.2% in 2023. The food price inflation forecast for 2024 is unchanged at 4.2%. The bank's forecast of headline inflation for this year is revised higher to 6.5%. Higher food, fuel, and core inflation are expected to keep headline inflation elevated at 5.7% in 2023. Headline inflation of 4.7% is expected in 2024, unchanged since the May meeting. Core inflation is forecast higher at 4.3% in 2022, rising to 5.6% in 2023. Our forecast for core inflation in 2024 is slightly higher at 4.9%. Core goods and services price inflation are forecast higher through to the end of 2024, compared to May when only core goods inflation was rising each year. Nominal wages are forecast to rise by 5.6% in 2022, 7.3% in 2023, and 5.7% in 2024. The risks to the inflation outlook are assessed to the upside. Global producer price and food price inflation continued to surprise higher in recent months and may do so again. Russia's war in Ukraine is likely to persist for the rest of this year and may have significant further effects on global prices. Oil prices increased strongly from the start of the war and may rise further as stresses in energy markets intensify. Energy and other administered prices continue to present short and medium-term risks. Given below inflation assumptions for public sector wage growth and higher petrol and food price inflation, considerable risk still attaches to the now elevated nominal wage forecast. Higher than expected inflation has pushed major central banks to accelerate the normalization of policy rates, tightening global financial conditions, and raising the risk profiles of economies needing foreign capital. We now expect G3 interest rate levels for the forecast period to be twice as high as expected in May. On balance, and with few exceptions, capital flows and market volatility are expected to remain elevated for emerging market assets and currencies. Alongside currency depreciation, other risks to the inflation outlook, such as increased food and fuel prices, have been realized, pushing up unit labor costs and expectations of future inflation. Average surveyed expectations of future inflation have increased to 6% for 2022 and 5.6% for 2023. Expectations for inflation based on market surveys have increased to 6.5. Long-term inflation expectations derived from the break-even rates in the bond market have also increased. In the second quarter of this year, headline inflation breached the target range and is expected to remain above it until the second quarter of 2023. By the fourth quarter of 2024, we expect headline inflation to revert to the midpoint of the target range on the back of declining fuel and food inflation. The forecast takes into account the policy rate trajectory indicated by the bank's quarterly projection model. As usual, the repo rate projection from the quarterly projection model remains a broad-based guide, changing from meeting to meeting in response to new data and risks. Against this backdrop, the MPC decided to increase the repurchase rate by 75 basis points to 5.50% per year with effect from the 22nd of July 2022. 3 members of the committee preferred the announced increase. 1 member preferred a 100 basis point increase. Another member preferred a 50 basis point increase. The revised repurchase rate path remains supportive of credit demand in the near term, while raising rates to level consistent with the current view of inflation risks. The aim of policy is to stabilize inflation expectations more firmly around the midpoint of the target band and to increase confidence of hitting the inflation target in 2024. Guiding inflation back towards the midpoint of the target band can reduce the economic cost of high inflation and enable lower interest rates in the future. Achieving a prudent public debt level, increasing the supply of energy, moderating administered price inflation, and keeping wage growth in line with productivity gains would enhance the effectiveness of monetary policy and its transmission to the broader economy. Economic and financial conditions are expected to remain more volatile for the foreseeable future. In this uncertain environment, monetary policy decisions will continue to be data dependent and sensitive to the balance of risks to the outlook. The MPC will seek to look through temporary price shocks and focus on potential second-round effects and the risks of de-anchoring inflation expectations. The bank will continue to closely monitor funding markets for stress. This concludes the MPC statement, and once again, our apologies for that technical glitch. I hope we have been able to recoup from that. And at this stage, let me turn to you, Zianda, to get questions from members of the media, please.
Thank you, Governor. We have a question from Claire Bisseka, Financial Mail. Inflation expectations have risen quite substantially in 2022 and 2023, according to the latest BER survey. How worried are you about this development? Does it mean inflation expectations have become unanchored? On the other hand, on a 2-year view, analysts' expectations revert back to the midpoint. What does this say about the credibility of the SARB? Those are all the questions I have for now. Thanks, Governor.
Thank you very much. We do not have to worry about our credibility. It has been hard-earned, and we will continue to protect it. We had started to deal with inflation much earlier than some of our peers last year. And with respect to the inflation expectations having risen, that is exactly why you act. You act because you are seeing inflation expectations rising. Do we think that they are unanchoring? No, we do not think so. But we have got to act to make sure that inflation expectations are not unanchored, because if they are unanchored, bringing down inflation will then become a very costly affair. You can rest assured that the South African Reserve Bank is determined to act on the rise in inflation that we have seen, and we are cognizant of the risks going forward, and we are prepared to act on those risks. We also hear the cries of South Africans about the rising prices. We hear the cries of South Africans that inflation is eroding their income, their salaries, and their wages. And we are determined as the South African Reserve Bank to protect the income of South Africans. And the steps that we have taken so far to act against rising inflation demonstrate our determination to protect the incomes of South Africans.
Thank you, Governor. We have a question from Alex Winning at Reuters. You have now raised rates for 5 meetings in a row, initially in 25 basis point increments and then by larger increments. Why don't you go for a much higher hike now, or for example, 150 basis points to really get inflation and inflation expectations under control?
Thanks for that. A higher hike was on the table. As you go into the meeting, nothing is off the table. 50 basis points was on the table, 75 basis points was on the table, 100 basis points was the table. Yes, 150 basis points was not on the table. We believe that the options that we considered was the full range of options to be considered given the current state of the economy and given the current data and the risks to both the inflation and economic outlook. We remain alive to the risks on the horizon. We will continue to assess the balance of risks, and we will recalibrate policy as appropriate given the data as it comes and given the outlook and the risks to that outlook. We believe that the step that we have taken is appropriate for the state of the economy that we are in right now. It is appropriate for the risks that we had assessed so far, but risks change. And if risks change going forward, we will recalibrate policy as appropriate.
Thank you, Governor. I have a couple of questions from Bloomberg, Pranisha Naidu. Her first question is, how effective do you think these rate hikes are going to be, given that most inflationary pressures appear to be cost-driven rather than demand-driven? Do you see as the main drivers for what do you see as the main drivers for long-term inflation expectations? The QPM shows core inflation will be higher than headline inflation in Q3 of 2023. When that happens, why would it be significant, and what would it say about this economy?
Can we take 3 like everybody does so that we do not lose track here?
Those are all the questions for now. We'll come back to.
The policy horizon in terms of the QPM is 3 to 5 months. Central bankers would tend to look at the thing and says 12 to 18 months sometimes. And the steps that had been taken from a monetary policy front must still feed through. The first policy hike took place in November last year. From November last year to July now is 8 months. It's roughly 2 quarters. It's basically 2 quarters. And so you must allow the steps that had been taken to transmit to the broader economy so that you could say how effective they are. We have actually, as part of the statement, published a policy rate path in terms of the QPM. And if we were to adhere to the policy rate path of the QPM, it shows that inflation by 2024 would be back at the midpoint of our inflation target range. Of course, this is economics. It's an imprecise science. It involves a lot of judgment. And that is why we say that the steps that we take going forward will continue to be data dependent. So when you assess the effectiveness of the steps that we have taken, you then have got to take into account the time horizon and the risks that you might have thought might not materialize and have materialized. And there might be risks that you thought would materialize that didn't materialize. And you have got to assess that balance of risks and exercise judgment. And I know you kept on referring to the QPM. Once again, let me state that the QPM is just but one input into the decision-making process of the MPC. We cannot outsource the decisions to a model. It is an input, and these good men and women have to make a judgment about what the appropriate policy stance is for monetary policy. Drivers of long-term inflation expectations, well, that you are still talking about long-term inflation expectations, you are talking of 5 years out. Monetary policy horizon is over a period of 2 years, about as I had spelled out earlier. And so you calibrate policy looking over that period. Bear in mind that monetary policy smooths fluctuations around the trend. So the steps that we are taking thus are about the policy horizon of monetary policy. There are other things that might be driving inflation higher. We have highlighted the issue of administered prices. There are the issues of the concentrated nature of our markets. There is also the issue of the labor market that we have that might not be responding to changes in economic activity that you continue to see when you have a weak economy, that salaries and wages continue to rise when you would have expected that there would be a moderation. But that is in essence what you are faced with. Core versus headline inflation, are we concerned? Well, can we understand what headline inflation is and what core is? Headline inflation covers everything. Core strips from headline inflation all the volatile parts of the price formation process. And that will be food, fuel, and electricity. That is what we strip out. And when you see core rising faster, it suggests to us that there are inflationary pressures that are building into the price formation process. And when that happens, you have got to act. And hence, you saw that in this meeting, we have taken a much bigger step than we have taken in the previous meetings, precisely because we are seeing the outlook for core rising over the policy horizon. Panel members, anything I've missed? No?
Thank you, Governor. We have 2 questions from Spelele Tludla at Business Report. Governor, you are very bullish about economic growth for this year in spite of upward risks to inflation outlook. Why is it that the SARB forecasts positive growth for the Q3 and Q4 when major economies are concerned about a possible global recession? The second question is inflation still peaking or it has stabilized?
We say that inflation, our forecast that inflation will continue to rise. And we said that we expect that it will stay outside of the inflation target range until the second quarter of 2023. And that after that, we expect it to decline. And that by 2024, we expect that inflation will be closer to the midpoint of the inflation targeting range. Are we bullish on about growth? Well, let's just do a simple arithmetic. Given the growth surprise that we have had in the first quarter, if this economy grows by 0% in each one of the remaining quarters, we will still grow by close to 2%. That is just basic arithmetic. So the way in which we would miss the growth target is if we have more than one quarter of economic contraction. We expect that the second quarter would be a contraction of just over 1%, and we will assess the picture as we go forward.
Thank you, Governor. Pranisha Naidu at Bloomberg. Eskom agreed to hike its workers' pay by 7% in what was probably the most high-profile wage negotiation of the year. How concerned are you about the precedent this one-year deal sets for other wage talks and the impact that this could have on inflation? Developed market central banks appear increasingly hawkish. How do you view the risks posed by this as well as the slowdown in China's economy? I'm going to round up her questions, two more, Governor. The SARB sees economy contracting 1.1% in Q2. Is this annualized or non-annualized? And what has driven the SARB to raise its 2022 GDP growth estimate? The last question, please elaborate on the MPC's thinking when it comes to striking the balance between tightening and not choking off growth. Thank you.
Okay, we analyzed the macroeconomy. So a settlement in one company is just that, is a settlement in one company. We, however, get concerned when you have got settlements that are consistently above expected inflation across the economy, because then that tells you that you are having a generalized increases across the economy, and it could lead to a wage price spiral. And once you have a wage price spiral, it's going to take even more drastic policy measures from a monetary policy perspective to deal with inflation. And we shouldn't be there. Developed markets turning more hawkish. I'm not sure that the developed markets have turned hawkish. Inflation has risen in the developed markets. Most of them target inflation of 2%, and they are now around just over 8%. Some of them are over 9%. So even after they have increased rates and indicated they might increase rates aggressively, they are still running negative real interest rates. So that we expect, as we had said, that we expect that interest rates in the developed markets will continue to rise. We did highlight that it does pose a risk for emerging markets in general and for South Africa in particular, because the tightening of financial conditions means that access to capital in the international markets is becoming more expensive, and that is what we would face. China is a complex story because it's a big consumer of commodities, and the current performance of our economy has to do a lot with developments in the commodities market. To the extent that China slows down and it doesn't purchase much commodities, it would have an adverse impact on the South African economy. And that is why in our presentation, we referred to the fact that the current account surplus that we have had is going to shrink and that it would actually turn into a deficit. So that is what we had seen. We expect the economy to contract by 1.1% in the second quarter of this year. And how do we balance growth and inflation? That is what this job is about. We primarily are targeting inflation and thus smooth growth around the cycles. So, as we smooth growth, or as the economists would like to complicate this, as we stabilize growth around a trend, we always have to be adjusting policy to make sure that we do not deviate too far from trend. But our primary responsibility is price stability. And to the extent that we are faced with a stark choice where you are having a weak economy or a contracting economy and inflation is rising, what economists call stagflation, you are going to have to deal with inflation, because failure to deal with inflation at that point would mean that it is going to be costlier to make the adjustments in the future, which might actually even choke growth even further if you do not act timeously. Unfortunately, that is what many central banks are facing at the moment globally, developed or developing countries, where you have got weak growth or contracting growth, and inflation is rising. That is exactly what we are having to deal with, and so are our counterparts elsewhere in the world. Yeah, I think I covered the things. Yeah.
Thank you, Governor. This will be the last round. We have a question from Atwell Dlamini at Alliance News. There was a time when inflation in South Africa and internationally was considered transitionary. How concerned are you that inflation is becoming permanent? How would you describe the current inflation trajectory? Thank you.
It doesn't follow that if inflation is not transitory, it's permanent. Actually, central bankers would say that it's either transitionary or it is persistent. So it's not permanent. And so when we had to take the steps in 2021, we were convinced that the rise in inflation is not transitory, that it might be persistent. At that time, because we were not sure about how persistent inflation was, we were acting in those baby steps of 25 basis points. And as soon as we seemed to pick a signal that inflation is becoming more persistent, we stepped up the adjustment of policy. Did it in 50 basis points then, and now we had to do 75 basis points. And that is because our assessment now is that this inflation risk is no longer transitory, but that there is persistence that is emerging. But that does not mean that inflation is permanent. And if there is persistence, the persistence is rising of inflation, you can rest assured the South African Reserve Bank will act with scale, timeously, to protect the incomes of South Africans.
Governor, I don't know if you'll take a last question from Claire.
You said it was the last question.
Yes.
So how many last questions do you have?
It's one last question. Thank you, Governor. It's Claire from Financial Mail. Why is your estimate of South Africa's potential growth so low and dropping for 2022 and 2023? Does that mainly reflect intensifying load shedding?
That's exactly what we said. We said that potential is low, and it had been hurt by intensified load shedding, but there are also the old structural constraints that South Africa faces that we had alluded to, that said that unless you deal with those structural constraints, South Africa will remain with this low potential. The concern that we have about the low potential is that you then have the bind where growth is faster than potential and thus closing the output gap at very low levels of growth at the time when South Africa actually needs to accelerate growth. So the same message that we had reiterated for years now remains. South Africa must take those difficult decisions and embark on the structural reform program successfully to raise the potential growth rate of this economy so that we can tackle the challenges that South Africa faces. Thank you very much. That concludes the proceedings of today.